The portfolio manager's screen reads 2:47 p.m. Nvidia hovers in the mid $130 per share. The quarterly rebalancing mandate sits open in another window. Index weighting increased, requiring hundreds of millions in additional purchases to maintain tracking. The price-to-earnings ratio displays in the high 60s. Revenue multiple, over 40 times. He clicks to the Insider Transaction tab. The figure updates. Well over $1 billion in executive sales over the last 90 days. He opens a historical comparison file. Cisco Systems, March 2000. Peak price approximately $82, revenue multiple in the mid-30s. Current price as of this morning, around $23. The manager highlights the purchase order. His cursor hovers over the execute button. The compliance officer appears in the doorway, checking on the rebalancing progress. The manager doesn't look up. The mandate doesn't ask if it makes sense, he says quietly. It asks, how much? Let me be completely clear about what's happening in late 2024. This isn't a technology story. It's a liquidity concentration event disguised as an infrastructure revolution. The boardroom scene opens in Q4 2024. Portfolio committees across institutional capital are reviewing technology allocations. The CFO walks through the year-to-date performance. Nvidia up substantially, now representing a significant percentage of total S&P 500 weight. The number feels abstract until you translate it into mandate language. For a $10 billion passive fund, that's hundreds of millions in a single equity position. For scale reference, that's more than most firms hold in their entire energy sector allocation. Here's how it works. The AI infrastructure narrative creates what appears to be a genuine capital expenditure mandate across hyperscalers. Major cloud providers have collectively committed to spending well over $150 billion annually on data center buildout. Nvidia captures the overwhelming majority of the GPU market share for AI training workloads, by some analysis exceeding 90% market share. The scarcity appears real because the revenue growth validates it. During 2024, year-over-year growth ranged from approximately 122% to over 260%, depending on the quarter. But here's the problem. The equity price isn't reflecting current revenue. It's crystallizing 5 to 7 years of projected growth at present value, assuming zero execution risk and perpetual margin maintenance. The valuation expansion follows a clean mechanism. Price-to-earnings ratios climb from the mid-40s to over 70, as the multiple inflates independently of earnings growth rate. The index passive inflow creates forced buying. Forced capital absorption likely reached tens of billions across tracking mandates in 2024 alone. The analyst consensus forms a distributed underwriting system. Numerous strong buy ratings with elevated price targets create the perception of professional validation. What's actually happening is narrative infrastructure maintenance during the distribution phase. Investment banks underwrite the exit liquidity for early holders, while retail and institutional late entrants absorb supply. The second-order effect triggers a self-reinforcing bid structure. Sovereign wealth funds and pension systems increase technology allocations to avoid benchmark underperformance. The career risk for an institutional manager isn't buying at 60 times revenue. It's underweighting the position and missing the rally. The tracking error becomes more dangerous than the valuation risk. You might be thinking this is sustainable because the revenue is real, not speculative. The product ships. The chips work. The hyperscalers are building out capacity. Here's how it works. Revenue being real today doesn't justify an equity price that assumes no competition, no margin pressure, no execution risk, and no market maturation for the next half-decade. You're not buying Nvidia's current business. You're buying a claim on revenue that doesn't exist yet, priced as if it's already been delivered. The asset is sound. The price paid for a claim on that asset is detached from any coverage ratio that would survive a normalization in discount rates. Now we have to address the elephant in the room. The product isn't the problem. The technology is legitimate. The business fundamentals are strong. The issue is the price you're paying for a claim on future cash flows that assumes perfect execution across a 7-year forward window. That's not a technology bet. That's a duration bet financed at near zero real rates, and those rates are no longer near zero. Bottom line, the wealth being created on paper in 2024 isn't new economic value. It's a transfer waiting to happen. Early equity holders who entered at single-digit to low-teen revenue multiples are preparing to monetize positions to late-stage capital providers entering at 40 to 60 times revenue. The mechanism is clean, rational, and entirely legal. It's also a classical bubble transfer, and the distribution phase is already underway. The Risk Committee convenes in March 2025. The Fed holds rates in the mid-4% range with no cuts signaled. The COLO desk flags an alert. Corporate debt refinancing costs are up substantially year over year. The implications take 60 seconds to propagate through the equity book. Here's how it works. Interest rate normalization increases the discount rate applied to future cash flows. High duration assets, growth technology with earnings weighted 7 to 10 years forward, compress first. The repricing mechanism is mechanical, not emotional. When the risk-free rate rises, the present value of distant cash flows declines. Equity prices adjust accordingly. Nvidia guidance disappoints in the sense that revenue growth decelerates to a still massive percentage. The number remains exceptional by any historical standard, but it's below the triple-digit expectations that justified the valuation multiple. The options market begins unwinding. Substantial gamma hedging positions reverse as implied volatility spikes. Market makers who were structurally long to hedge short volatility positions start selling the underlying equity to rebalance. Margin-financed retail positions face calls. The forced selling begins in accounts that used leverage to amplify exposure during the rally phase. Simultaneously, passive outflow accelerates. Redemptions from growth-focused funds trigger mechanical selling, regardless of manager conviction. The fund doesn't have discretion, it sells proportionally across holdings to meet redemption requests. Insider distribution accelerates. Executives exercise options and sell billions in equity over a concentrated window. The transactions are legal, disclosed, and entirely rational. They're also a clean signal about expected forward returns from holders with the most information. The second-order effect hits institutional risk models. Compliance departments flag concentration, risk. A single equity position representing a significant percentage of total portfolio value triggers automated review. Even managers with high conviction on the fundamental thesis face forced position reduction to meet risk management covenants. You might be thinking this is a healthy correction, a buying opportunity. The company is still growing, the technology is still necessary. The pullback creates entry points. Here's how it works. Corrections require marginal buyers with dry powder willing to step in at lower prices. But current holders are already fully allocated. Passive funds are mechanically selling, not buying, because redemptions exceed contributions. New capital won't enter at 50 times revenue even after a 20% drawdown, because 40 times revenue is still detached from fundamental coverage. The bid support disappears not because the story changed, but because everyone who believed the story already bought. But here's the problem. The liquidity that inflated the equity price was asymmetric. Early holders could sell into deep, liquid markets with continuous bid support. Late holders are discovering that exit liquidity requires a marginal buyer, and the marginal buyer has already been absorbed into the position. The market can stay irrational longer than you can stay solvent, but it can also become rational faster than you can exit. So what does this actually mean for the portfolio manager executing that purchase order in the hook? It means the mandate is forcing capital deployment into a position where the institutional sellers have more information, better timing, and lower cost basis. The transaction is rational for both parties, but the payoff distribution is asymmetric. One side is locking in gains. The other side is financing those gains with principal that needs a 60 to 80% rally just to break even. Bottom line, the bid isn't disappearing because the story changed. It's disappearing because everyone who believed it already bought. What remains is forced buying from passive mandates, absorbing supply from informed sellers, executing planned distribution. That's not a market. That's a transfer mechanism. The analyst call takes place in June 2025. The opening line, "We maintain our price target. Fundamentals remain intact." These are the same analysts who issued strong buy ratings at higher levels. They're now issuing strong buy ratings at substantially lower prices. The price target gets quietly reduced in a footnote, but the recommendation holds. This is narrative maintenance, not analysis. Here's how it works. The media narrative shifts to long-term hold framing. Translation, don't sell at a loss. Financial television brings on strategists who recommend dollar cost averaging. The advice is technically sound for building positions in fundamentally priced assets. It's financially destructive when applied to positions purchased at 40 to 60 times revenue that are repricing to 20 to 25 times revenue. The corporate response follows a standard playbook. A multi-billion-dollar buyback authorization gets announced. The headline creates the perception of a floor. The market interprets it as management confidence. What's actually happening is temporary bid support that retires a small percentage of shares outstanding. It sounds meaningful until you calculate the passive outflow potential. If redemptions accelerate, passive funds could sell massive amounts in a single quarter. The buyback absorbs a fraction of potential outflow. It's a signal, not a structural support. Index providers maintain weighting despite the price decline. This forces continued passive inflow even as the price compresses. Rebalancing mandates don't evaluate valuation, they evaluate weight. As long as the position remains a major index holding, passive funds mechanically buy on any dip that increases the weight relative to the index. The retail narrative adapts. The buy the dip psychology activates. Behavioral finance. Research on this is clear. Investors who experience gains in a position develop anchoring bias. They use peak price as the reference point, not fundamental value. A stock that has declined significantly from peak feels cheap, even if current price still represents elevated multiples and lower price levels would represent fair value. Institutional positioning shifts to conviction hold language. This is code for sunk cost fallacy. Managers who bought at higher levels cannot sell at substantially lower prices without crystallizing significant losses and triggering career risk. The incentive is to hold, wait, and hope for recovery. The position becomes illiquid not because of market structure, but because of institutional psychology. The options market provides temporary support through a different mechanism. Market makers who sold put options must hedge by buying the underlying stock as the price declines. This creates mechanical bid support that appears as demand but is actually hedging activity. When volatility stabilizes, that bid support disappears. You might be thinking buybacks create a floor. Companies with strong balance sheets can support their equity price through repurchases, right? Here's how it works. Substantial buybacks at reduced prices retire only a small percentage of shares outstanding. If passive outflow accelerates significantly per quarter, entirely possible if growth funds face sustained redemptions, the company would need to deploy hundreds of billions annually just to absorb the selling pressure. The balance sheet can't support that. The buyback is a signal of confidence, not a structural floor. Now we have to address the elephant in the room. The rescue mechanism only works if revenue growth re-accelerates to justify current multiples. If growth normalizes to 15 to 20%, still excellent by historical standards, the equity needs to reprice another 40 to 50% to reach fundamental coverage. No amount of narrative. Maintenance changes the math. The price paid needs to align with the cash flow delivered, and the gap is still enormous. Bottom line, the floor isn't set by buybacks. It's set by the price where cash flows actually cover the equity claim. That price is substantially lower than current levels and substantially lower than the entry point for late-stage capital providers. The transfer is in progress, and the rescue narrative is part of the distribution mechanism. The pension fund quarterly review takes place in November 2025. The position is down substantially from peak. The rebalancing mandate has reversed. The fund now must sell to reduce an overweight position, created by the price decline's impact on the overall portfolio weight. Let me be completely clear about what happened during the distribution window. Early holders, equity acquired in the years before the rally, fully exited positions in elevated price ranges. The timing wasn't coincidence. Lockup expirations, pre-planned, trading programs, and secondary offerings were structured during periods of maximum liquidity. Post-earnings announcements, index rebalancing dates, and high-volume windows. Insiders distributed billions in equity across an extended window. Retail accounts absorb significant supply through fractional share accumulation platforms. The accessibility of fractional shares and zero commission trading removed traditional entry barriers. Retail accounts collectively hold substantial unrealized losses on positions accumulated at elevated prices. The capital came from retirement accounts, brokerage accounts, and leveraged positions that are now underwater. Passive funds mechanically sold to maintain index tracking. The price decline reduced the position's weight in major indices, triggering automatic rebalancing. The fund managers had no discretion. The algorithm sold proportionally across all holdings to match the index weight. Active fund redemptions, forced selling, regardless of manager. Conviction. An equity manager might believe the position is undervalued at lower levels, but if the fund faces net outflows, the manager must raise cash by selling liquid positions. Despite the price decline, the stock remains one of the most liquid equities globally. It gets sold first to meet redemption requests. Institutional tax loss harvesting creates additional December selling pressure. Funds with fiscal year-end capital loss carry-forward opportunities sell losing positions to offset gains elsewhere in the portfolio. The selling is rational from a tax perspective, but adds to downward price pressure during year-end. Price discovery fails in intermediate ranges. There are no natural buyers at any price level in that band. Early holders exited higher. Late holders are trapped lower. New capital waits for fundamental coverage, which doesn't arrive until substantially lower prices. The bid-ask spread widens. Liquidity evaporates despite massive trading volume. Fundamental analysts finally publish reset reports. Fair value estimates suggest substantially lower price levels based on normalized multiples. The reports don't say the company is failing. They say the price paid was detached from the value delivered. The asset is sound. The equity claim at peak was not. The second-order effect triggers contagion across the broader AI equity complex. Companies with zero revenue but multi-billion-dollar valuations reprice toward zero. The narrative infrastructure collapses. AI infrastructure spending forecasts get cut. The CapEx mandate that justified the initial rally moderates as hyperscalers extend deployment timelines and optimize utilization rates. You might be thinking this is 2000 all over again, but Nvidia has real profits unlike the dot-com companies that went to zero. Here's how it works. Cisco had real profits in 2002, approximately $2.7 billion annually. The company was legitimate, profitable, and dominant in networking infrastructure. The issue wasn't profitability. It was the gap between equity price and profit scale. At peak, investors paid for 40 years of earnings upfront. When the multiple compressed, the stock declined 80% despite continued profitability. Nvidia's situation has the same structure. The profit is real, but at peak you paid for 40 years of earnings upfront. The repricing doesn't mean the business failed. It means the price was wrong. So what does this actually mean for the pension fund beneficiary whose retirement account was mechanically allocated at elevated prices? It means their capital financed the exit of early holders who bought at much lower levels. The transfer was legal, disclosed, and executed through market mechanisms. But the outcome is binary. One party crystallized gains, the other party absorbed losses. Bottom line, the bag wasn't empty. It was just worth substantially less than the price paid. The asset remains valuable. The company remains profitable, but the price paid for a claim on that asset was detached from fundamental coverage, and the repricing extracted that excess from late-stage capital providers who entered at peak valuation multiples. The Bloomberg terminal updates in March 2026. Nvidia trades in the low 50s per share. Price-to-earnings ratio, low 20s. Revenue multiple, low double digits. The screen displays a 52-week range showing the full journey from peak to fundamental coverage. The tally is complete. Here's how it works. Wealth transfer complete. Early holders crystallized hundreds of billions in gains through exits executed across the peak period. Late holders absorbed corresponding losses through entries during that same window. The transfer wasn't theft. It was a market mechanism functioning exactly as designed, separating patient capital from impatient capital, rewarding information advantage, and penalizing FOMO-driven entry without price discipline. Passive funds rebalanced at a loss. Fiduciary duty was met. The funds tracked their benchmarks with intolerance. The beneficiaries paid the spread between entry price and exit price. The mandate was followed. The capital was destroyed. Retail accounts remain in forced hold. Most retail investors lack the tax loss, harvesting sophistication to crystallize losses strategically. They hold positions at reduced prices, waiting to break even at entry prices that were much higher. That break even requires substantial percentage gains. The position is now fundamentally priced, meaning future returns will track earnings growth, not multiple expansion. At normalized growth rates, break even could take 7 to 12 years. Many will capitulate before then. Fundamental coverage is achieved. The equity price now reflects reasonable multiples for revenue and earnings. These are appropriate ratios for a profitable, dominant technology company with strong competitive position. New buyers at current levels have rational risk-return profiles. They're paying for the asset, not the narrative. Original late buyers who entered at peak need the stock to nearly triple just to recover principal. The business fundamentals remain sound. Nvidia is profitable, dominant in AI chip design, and well-positioned for sustained demand in data center infrastructure. The asset didn't fail. The company didn't collapse. The product didn't become obsolete. What failed was the assumption that equity price could permanently detach from revenue and earnings coverage. The second-order effect arrives in institutional risk committees. Concentration limits get implemented. Momentum factor restrictions get codified. Valuation cap weighting proposals get circulated among index providers. These are exactly the policies that would have prevented the loss. They get implemented after the loss, ensuring they'll be relaxed during the next cycle. You might be thinking, this proves markets are irrational. How can sophisticated institutions and informed investors collectively participate in a bubble transfer? Here's how it works. Markets are perfectly rational transfer mechanisms. Early holders rationally sold at irrational prices to late holders who rationally feared missing the rally. The mechanism worked exactly as designed. Career risk for institutional managers isn't losing money, it's underperforming benchmarks. A manager who avoided the position during the rally underperformed and likely lost assets under management. A manager who bought during peak met fiduciary duty by tracking the index. The personal outcome differs, but the institutional incentive was rational throughout. Now we have to address the vulnerability. The mechanism persists because index mandates create forced buying regardless of price. Passive vehicles cannot price discriminate. Retail access to leverage removes entry barriers. Career risk for managers who underweight mega-cap winners exceeds the risk of buying overvalued positions. Bottom line, the bubble didn't pop. It transferred. The wealth that appeared on screens during peak was redistributed. Early holders extracted it. Late holders financed it. And the mechanism remains intact. The portfolio manager's screen glows at 2:47 p.m. The cursor hovers. The order, $340 million at $52. The mandate updated, reduced position by $180 million. He executes the sell. The wealth doesn't disappear. It moves.